Jim, I don't think you need any introduction. We know you from our airwaves. We know you from TV. We know you from your name at the top of or the bottom of reports. You're very well known to a lot of people, but you're an economist. And I'm not sure everyone might see Jim Power, but they might not know what economist is. What is an economist?
Okay, I've worked as an economist in the private sector for 35 years. I was clearly very young when I started. But what we do as economists, we try and analyse what's happening out there in the economy. And at the end of the day, an economy is made up of all of the economic transactions that occur on a daily basis. So when I go in and buy a cup of coffee, that is an economic transaction. It becomes part of economic activity. One of the, I think, misconceptions about economists is that we're capable of forecasting the future. We're not. Economics is a social science. It's driven by human behaviour. And as you know from your TV series and working with your clients, people do not always behave rationally.
Yes.
So you are dealing with a lot of human behaviour. You're dealing with political events, but you're trying to analyse, what's happening in an economy. Because at the end of the day, one needs a functioning economy to generate the resources that fund everything else. So economic activity and the taxes that flow off that economic activity and the wages that are paid to people who engage in economic activity, those are the resources that are used to fund the health service, education, the roads, all the other infrastructure and so on. So we're trying to analyse what exactly is being created. Can you improve the manner or the quantity of what is being created? And then we try and analyse what would be the best possible use of those resources to achieve the best possible outcome for as many people as possible. And unfortunately, it is a very subjective subject in the sense that what I would regard as a very positive outcome, you might regard as not so positive an outcome. So it's difficult to reach definitive conclusions, but it's basically about analysing the economic activity that's occurring out there and understanding how that impacts on our lives.
Okay, so basically what you're doing is you take a measure, and whatever way you measure it, what's happening with people's money on a day-to-day basis, and you look at what they've done in the past, and then you try and, I don't like to use the word guess, but you are guessing about what way they might behave in the future and how that might impact the economy, positive or negative, and make changes to try and make it positive.
Yes, I mean, at the end of the day, people's lives are heavily dictated by what's happening in the economy. It determines what you're going to earn if you work. It determines what you're going to pay for goods and services. It determines the goods and services that are available. It determines the quality of life you're going to have. Can you have access to proper health service, education, whatever. But also, the economic environment determines where interest rates are. So over the last couple of years, people have been dealing with a circumstance that they haven't seen in decades, which is inflation. And that inflation has resulted from economic and political factors, okay? But that inflation and the reaction of central bankers to that on the interest rate front has had a fundamental impact on people's lives.
Yes.
And we as economists try and explain and understand what exactly is driving these forces. And we then try and extrapolate those forces forward. What is likely to happen inflation over the next couple of years? What does that mean for interest rates? What does it mean for people's quality of life and standard of living? What they can expect to earn? What they can expect to spend? All of those questions. But the big proviso, and I think everybody should really, really remember this, there is no certainty. Stuff happens. COVID hit in March 2020 and fundamentally changed the world. Then, just as we were returning to a semblance of normality in February 2022, we had the Russian invasion of Ukraine, which created a whole load of other circumstances that we're living with. So there is no certainty, but one has to plan. One has to try and figure out, what's my life going to look like? What are the risks to that? Is there anything I can do to avoid or mitigate those risks? And that's the role of a financial advisor as well, to help people understand and make these decisions.
Let me ask you, if you sat down in January 2020, so the first lockdown was March 2020, so January 2020, and you sat down, and if someone sat down and said, this is exactly what's going to happen to the world from an economic point of view, right? we're like, you probably have the bigger numbers in terms of the world, or maybe you don't in terms of the level of unemployment, the level of government supports, the level of money that was going to be, that all the shops were going to be shut down, that this is what's going to happen to the economy in the next 12 months. Where would you have predicted we would have ended up? Or what would you have imagined, or how could you have imagined where it could have ended up?
Well, the view back in January 2020, and I sit down every January to try and, forecast, and I use the word guardedly, what the coming year is going to look like. And back in January 2020, I had a pretty upbeat assessment. The world was coming back. There was a sense of normality because we had lived through 12 or 13 incredibly unusual years following the global financial crash back in 2008, 2009. But there was a sense in 2019 into 2020, the world was returning to normal. So, I was expecting for 2020 a reasonable level of economic activity. Wages would pick up, inflation would remain well behaved, interest rates would rise a little bit, but not very much. So it was a pretty benign view of the world that I felt pretty confident about insofar as one can. And then, of course, the first week in March 2020, COVID-19 was declared a global pandemic. Suddenly we were faced with a set of circumstances that we'd never seen before. Businesses were shut down. We as consumers were not allowed to do certain things. So there was an absolute collapse. And, the economic fallout initially was dramatic. But then policymakers stepped in. Policymakers and government particularly did amazing things everywhere, not just in Ireland during COVID. They supported small businesses. They supported households because they recognised that at some stage COVID would pass, that this very unusual situation would pass. We would have to rebuild the economy. And to rebuild the economy, it was always going to be essential that, number one, households were solvent and hence they had to be supported during this period. And secondly, that all of those small businesses that generate economic activity, that they would be in a position to get up and running and drive the economic recovery story. So, from a social perspective, COVID was absolutely, it was awful. It was a dreadful experience for many people, and the implications of that will be felt for years to come. But the economic impact, while very sudden and very sharp, actually the Irish economy and indeed the global economy recovered much more quickly from that than one might have expected, given the nature of the shock. Governments played a key role in that because of the support that was provided. Central banks slashed interest rates. They engaged in, I don't want to delve into technical jargon here, but quantitative easing, which is basically increasing the supply of money circulating in an economy. But so all of these factors were really important. But the other thing, and I think this is really, really important, human nature being what it is, we want to get back to normal as quickly as we can.
Yes.
And we did. So,
and did that not cause the problem? Is that not, if interest rates, or not certainly interest rates, inflation, right? Was it always inevitable that we have a very closed economy, very open economy, very quickly? Like typically my understanding is if you look at stock markets every 3 to 5 years will have a crash or some type of major event. And they happen every 3 to 5 years and they recover and we get back. But they generally, it's a crash and then it slowly builds back up again. Whereas with this, it was economy completely closed, economy completely open, more or less. Was it inevitable that we were looking, given the 13 years we had pre-COVID, given the monetary policy prior to that, the interest rates where we were at, then we go through COVID, everything's closed down, everything's open. Was it inevitable we were going to have a ridiculous inflation, or could we have done anything differently about it?
Well, you can say at a general level that, prices are determined by demand and supply. And if demand is stronger than supply, prices will tend to rise. That applies to the housing market, it applies to stocks, it applies to the goods and services we buy as consumers or as businesses. So it's a little bit more complicated than that, but it's basically a demand-supply story. And from 2008 up to 2020, we did live in a very unusual environment. Interest rates were at historically low levels. Central banks were engaging in this quantitative easing or printing of money. So, and the reason why those policies were put in place was to help economies and businesses and households deal with the fallout from that crash in 2008, 2009. Because never forget, globally, that 2008, 2009 period, is being written up correctly in the same way as the 1920s and the Great Depression, all that. It was that sort of cataclysmic event. It was extraordinary. And, people would say there was way too much support given. There was too much money pumped in. Interest rates were too low for too long. And I would accept that to a point. But I would then ask the question, if those policies had not been put in place, how much worse would the situation have been? Because when you get into a crisis situation, there are no easy answers, as some people might suggest. So there was a kind of an inevitability, but then that inevitability came to fruition with COVID, because during COVID, basically, the supply of goods and services was shut down or seriously constrained. Okay, the demand was also seriously constrained because we as consumers, it was very limited what we could spend our money on. So we were saving. Businesses likewise were putting investment on hold because what was the point in investing? So we had this serious constraint on supply. Demand was constrained. Then the restrictions were lifted pretty quickly in different jurisdictions, but pretty quickly generally. So what we saw happen was this resurgence of demand coming up against supply constraints. Prices increased and we got this inflation problem. But then at the beginning of 2022, the view from central bankers was this is transitory because, over time, supply will come back on stream.
Can I just ask you, was it transitory? So basically what they were saying at the time was this is just a shift from a closed economy to an open economy, right? Was it that? Or is it, my understanding is the European Central Bank has a single mandate. They can only use interest rates to keep inflation at or about 2%. And where inflation goes over 2%, they need to justify the reason why they're not increasing interest rates. And was this not their excuse? This is transitory and it's going to fix itself. It's just closed economy, open economy. Here we go. It'll fix itself. And we're going to leave interest rates as they are, because they were worried about the increasing interest rates and the impact that would have on businesses.
Yeah, they were indeed. I mean, and what this demonstrates is that back at the beginning of 2022, central bankers were as uncertain as the rest of us. And it just proves the point that economic forecasting is not an exact science. But the view central bankers were taking in the first quarter of 2022 was this is a transitory problem. Supply is going to come back on stream. This resurgence we saw in demand would level off because we had sort of caught up with all the consumption we wanted to engage in, and things would normalise and inflation would come back down pretty quickly. But then, of course, when the Russian invasion of Ukraine happened, we saw a serious energy supply shock. Prices rose dramatically. We saw food supply shock. Prices rose dramatically. And a lot of other construction materials, etc., were also hit. So we got this extra shock coming on top of an existing shock, and that just exacerbates the situation. And suddenly, central bankers start to realise, actually, this isn't transitory. We are going to have to act aggressively. And central bankers took the view as 2022 progressed, we will do whatever we have to do to get inflation back under control. If that means taking interest rates to a level that's going to seriously undermine economic activity, that is going to force unemployment higher, so be it. That is a price worth paying to prevent inflation from becoming entrenched in the system and in psychology. And the lesson they would have been looking at was what happened in the 1980s after the two oil price shocks in the 70s. Inflation became embedded in the system. And there was a quote from that period that the persistence of inflation increases with the rate of inflation.
Right.
What that means is, and this is the human behaviour piece of economics, it is a social science, I stress that again, we build in higher inflation into our behaviour. As workers, we look for higher wages to compensate for higher prices. The vendors of goods and services increase their prices to compensate for the higher wages they're paying, and it becomes a vicious cycle.
In simple terms of what you're saying there is I'm saying to myself, oh, that was €100 last week. It's now €101 this week. I'm going to buy it before it goes to 102, and therefore it drives on inflation.
Exactly. Okay. That's it. If you believe prices are going to rise, you buy today, and that becomes self-fulfilling.
I'm also on record as saying a couple of times, because it's my belief, and I'd like you to question my belief if I'm wrong, right? I do believe that if inflation's running at 8% in Ireland, whatever, 6-8%, wherever we're at right now, okay, that if you get a pay rise of 10%, well done, you've beaten inflation. Okay? But if everybody gets a pay rise of 10%, we could really be in trouble. Do you think I'm right in saying that?
I think you're absolutely correct, because if you're getting wage increases that are higher than inflation, or that are high full stop, that just fuels demand. And when you fuel demand, that just exacerbates the upward pressure on prices.
Okay.
So you're
Okay.
absolutely correct in that assertion, in my view.
Circle back to something that you said a second ago. So if we talk about the single mandate that the European Central Bank, we have to use interest rates to get inflation to 2%. Sorry, just go down. We have to use interest rates to get back to 2% inflation. Right? That's what we're going to use interest rates for. And you've just mentioned they were going to do it at all costs, even if it meant unemployment. My understanding is that, or my belief, because I'm looking at it from individuals' point of view, if inflation's at 10% and you're making 200 quid a week on social welfare, and your shopping bill, just to make the math simple, goes from 100 to 110, that really impacts you, right?
Yes.
Whereas if you're on 1,000 a week and your shopping bill goes from 100 to 110, it still impacts you, but has less of an impact on you. How much did the ECB think about that person when they're trying to get inflation rates back to 2%?
The European Central Bank did not think about the sort of sectoral impact or the societal impact of higher interest rates. It is a blunt instrument, okay? They increase interest rates to dampen economic activity, and there will be, big losers from that. You mentioned social welfare recipients, for example. But the central bank view would be, it is our job to keep inflation under control. It is the role of government using taxation and expenditure to help those people that are most adversely affected by what's going on. And our social welfare system in this country, which is one of the most redistributive social welfare systems in the world, we do look after people, the victims. But inevitably, there will be people receiving money from government that don't need it.
Yes.
But it's very difficult to be to exactly be precise about where the help is going to be directed. But, government is doing it here. We've had various cost of living packages introduced. We will see another one in the budget in October. So government steps in to try and help those sectors and sections of society that are most adversely affected by these policies.
Okay.
That is not the concern of the European Central Bank.
The European Central Bank is just get it to 2% so that you guys can do your jobs. That's
exactly.
So, as in the governments of Europe can do their job in helping their own economies. Before I ask you where we're going to, where do you think we are in the world economically right now? Where are we in Ireland? Where are we in the world?
Well, I mean, if you think about the world in the last couple of years, we've been subjected to a huge escalation in inflation, the highest level in 40 years. Interest rates have increased dramatically. They've gone from 0 to 4.25% in the euro area. They've gone from 0.1 to 5.25% in the UK. They've gone from 0 to 5.5% in the United States. This has all happened basically in a 12, 18-month period. That is a dramatic tightening of interest rates. Okay, one might have expected the economic impact of that to be a lot more severe than it actually is. And that is what's worrying central banks at the moment. Actually, the global economy is still doing reasonably well.
Is there any chance that's because people haven't seen the impact of it yet? And I'm just giving you an anecdotal.
There is a time lag, absolutely.
Yes.
It takes 12 months for an interest rate change to fully feed through the system. And that's why, in my view, central banks should now take the decision. We've tightened rates enough. Let's sit back and see how this materializes over the next 12 months. But at the moment, central banks are still in panic mode. I think they are going to increase interest rates a little bit further and then see how that washes out. And I go back to the point I've made several times already about central banks are no more certain than the rest of us about what's going to happen. Economic forecasting is not a precise science. You can never be certain about outcomes. But as I say, central bankers are going to continue to apply a cautious approach because they still recognise that inflation is too high. The global economy has slowed significantly. The global economy this year is forecast by the IMF to grow by about 3%.
Right.
5% will be sort of the potential. So it's growing below potential, but it's still reasonably stable. Over the next 12 months, I would expect the global economy to slow further because that's what central banks want to get inflation under control. I would expect unemployment globally, which is currently at very, very low levels, to increase a little bit.
Which is interesting because this time last year there was a lot of talk of global recession. I know we had technically a recession earlier on this year in Ireland in terms of farmer dragged us into recession, technically. Am I correct?
Yeah. Technically, GDP contracted 2 quarters,
Yeah. So where do you see is that narrative has kind of disappeared? We don't have a big fear of a global recession anymore, do we not?
Well, no. I mean, the global economy has actually surprised on the upside over the last couple of years. There is no doubt about that, given all of the headwinds that it has faced, particularly the inflation and the interest rate response to that. The Irish economy, has performed really strongly. Some of the indicators are really good. For example, last year we took in 83 billion in taxation. This year we're probably going to take in more than 90 billion, which is a record high. And there is no greater indicator of what's happening on the ground in an economy than the tax that's being collected. The labour market is really hot still. We have 2.64 million people working, which is the highest level of employment we've ever had in this country. The unemployment rate is at 4.4% of the labour force, which is virtually full employment. So those two indicators are certainly suggestive of an economy that's doing reasonably well. But even consumer spending, which has weakened a bit, it is still holding up reasonably well. So
we're not in a bad place then.
No, we're not in a bad place. But one can never get complacent about this because, for a small open economy like Ireland, external factors can have a huge impact. So I think the really important piece here is that while the economic outlook is quite positive, I think it is really important that government continues to support those parts of the economy that need support. And, households, the SME sector, they will require ongoing support from government. But bottom line is, Ireland is doing reasonably well, but we've also got to recognise and I often get accused of, I'm an optimist, I'm a natural optimist. And when I talk about these Irish economic indicators, but what about?
Yeah.
And the what abouts are very real. Housing to me is the biggest social, economic and political crisis that probably we've ever faced as a country, in decades.
And just before we go on to that, Jim, because I want to just wrap up there in terms of the inflation and the interest rates before we move on to housing. When we think about where we're at right now, we're in a good place. You are expecting that we may have one more rate rise, and then your ideal would be we might wait and see, or maybe just wait and see right now. Maybe not even without the rate rise. Is that fair? Or you expect them to go up again and then wait and see?
The risk is the ECB will go probably one more time.
Okay, so they go one more time, and whether they do that immediately, I kind of have a thought that if I were them, I'd be holding it in my back pocket, because if you're going to do it once, let's see when between now and Christmas we do it, not necessarily at the next one. And then we plateau for a while and see where it's going. You have that one in your pocket ideally. That means people's interest rates in general shouldn't be changing, but our banks have a little bit. I'm talking about interest rates on their mortgages. In general, they should be staying level, but they won't, I don't believe, and disagree with me, because I think the banks will start to catch up.
Yeah.
We've gone from being the most expensive in Europe to being the third cheapest in Europe was the last time I looked at it. So they're going to start squeezing that a bit and getting a bit more profit. So that's where I kind of see, I don't see interest rates coming down anytime in the next 12 months. And therefore mortgage interest rates in a normal economy wouldn't be coming, a normal functioning banking environment wouldn't be coming down in the next 12 months. Do we see hope for 2025 on interest rates? Do we see 2025, 2026? Do we think this is the new normal? Where do you think your head is at in terms of?
I think that there is this concept of a natural rate of interest. And I think for the euro area, the natural rate is around 2.5%-3%.
Okay.
And it's depending on what rate you look at, but the equivalent I'm talking about here is 4.25% in the euro area at the moment. I think we've gone a little bit overkill. We will persist with overkill for a while, but in 2025, I would expect rates to come back down a little bit and normalise around 2.5%-3%.
So is it fair to say if the ECB rate is the normal rate, if that's what it is 2.5%-3%, that mortgage rates are probably normal at around 4%? Is that fair in an ordinary functioning banking environment?
Absolutely.
Okay.
Yeah.
Okay, so for the individual, in and around 4% is probably the long-term normal. But we don't know what surprises we're going to get hit with, of course.
Well, yeah, I mean, and that is the point. You can never be certain about this because there's always something lurking in the background. People might say, oh, wouldn't it be great to see interest rates coming down dramatically over the next couple of years? But actually, if they did come down dramatically, it would signify that the global economy was in trouble again.
Absolutely.
So the level of interest rates we lived with for up to 2021 really was abnormal.
Yes.
Historically low levels of interest rates reflecting at a global level significant challenges. So there is a level of interest rates that is sort of consistent with a stable economic backdrop.
That's fair. That's very fair. Let me jump to housing, Jim. And what I would say is I know what I would just want to say, just so you don't think I caught you out, I am very public, and it's a phrase I use from repeatedly when I'm asked questions. People will ask me, what do we think is going to happen with property prices in the next 12 months? And what I always say, and because I'm in front of an economist now, what I always say is anyone who tells you what's happening with house prices in the next 12 months is guessing or lying, right? They're lying because they've reason to lie, or they're guessing. It might be an educated guess, but it's a guess, right? So just to preempt.
100%.
But where do you see house prices going in the medium term, short term, long term, whatever? Where do you see house prices going?
Well, I think there is it's a complex question, okay? There's no simple answer to that. But at a fundamental level, there's two things that drive house prices. One is the supply of housing. And a lot of the discussion on housing tends to focus on social and affordable. There are three elements of the housing market. There's the social and affordable, there's the rental market, and there is the owner-occupier market. Okay? So the supply needs to be addressed in all of those three areas. We cannot have all of the focus on building social and affordable. We need to build rental properties. We need to build houses for people, owner-occupiers who want to buy. So and at the moment, this year, we're going to deliver probably less than 30,000 new houses.
Yeah.
We should be delivering sort of 50 at least, okay?
Yeah.
Because for 10 years, basically 2008, for the next 10, 12 years, we delivered 8,000 houses per annum.
And let's put that in perspective, because in 2007, we were delivering close to 80,000, weren't we? We were capable of delivering 70, 80.
In 2006, we delivered 93,000.
Wow. Wow.
And so that there is that capability, and then of course we shut down the construction sector. And that was a massive mistake, because the one thing we do know about the Irish population, it's growing.
Yes.
And there's also a lot of young people in that household formation age group. So there is a fundamental supply problem here that will take years to address and will require very brave political decisions, particularly on the planning side.
Yeah.
So I think supply is going to remain a constraint. The demand is also, the other side of the equation is very strong. We have a growing population. In the April 2022 census, for example, we had the highest population since the famine in 1834 or thereabouts, okay? It's been growing significantly. I think back in the early 60s, we had about 2.7 million people living here. Okay, we now have over 5.1 million. So... And of course, within that, we also have a relatively young age profile. There's a lot of people in that 25 to 40-year-old age group, which is the household formation age group. We still have a lot of people in that segment. So if you think about lack of supply, ongoing strong demand, that would suggest that the market will remain hot. Okay. And over the cycle, of course, things happen. Rising interest rates take some of the heat out. And we've seen in the last 12 months, the market has softened a bit. But that's because of interest rates. It's not because we're increasing supply sufficiently, or it's not because the demand has gone away. It's because of other factors. So I unfortunately think on a 10-year view, house prices are likely to continue rising. Okay. And I say unfortunately because I don't believe an environment where house prices are growing strongly is a good environment from a social or an economic perspective, because it means that with house prices rising, we're being forced to take on bigger mortgages. There's more money being sucked into the housing market and away from other activities in the economy.
Yeah, okay. You're ever the optimist. You've admitted that. You tend to look at the positive side of things. Final question. What are your what are your big what ifs? What are your big what abouts? Your big fears that might threaten us, that you can see on the horizon that could become a problem?
Well, at a global level, my big fear is global geopolitics.
Okay.
The world is a scary place at the moment. The relationship between China and the United States is becoming very, very dangerous. And I think given the Taiwan situation, it could become a lot more dangerous. We obviously have the ongoing war in Ukraine that's showing no sign of ending. So there's a lot of global politics at the moment that scares me. And unfortunately, political actions have economic consequences. And we've seen that from the Ukraine war, for example. So at a global level, that is my big fear, because that does impact on Ireland. Domestically, you know, I think it's the things that worry me is we don't get on top of housing.
Yes.
You know, it continues to be a serious social and economic issue. And at the end of the day, you know, for a small open economy like Ireland, competitiveness is really important. To attract foreign direct investment, to attract employment, we need to have a competitive environment. And unfortunately, I don't think we've seen enough recognition of just how important housing is as an indicator of competitiveness.
Yeah.
And the IDA will now say that housing is starting to become an issue in terms of attracting employment into the economy. So my fear will be we actually just keep doing what we're doing. We don't address the housing problem. So that's one thing. Second thing would be, you know, if the political landscape here were to change significantly and it was to become sort of very anti-business, anti-entrepreneur, high-tax economy, that would very quickly drive economic activity out of the country. That would worry me. Because political events do have economic consequences.
Yes.
We should never forget that. Ireland is in a pretty good place at the moment. There are significant problems with housing, with the health service, with law and order and so on. But show me a country that doesn't have these sorts of problems at the moment. It's universal. I think I would love to see Ireland actually taking a bit of a global lead in addressing these issues. And of course, climate change is the other big one that will fundamentally change things. So provided we continue to pursue sensible economic policies, you know, there's no reason why Ireland shouldn't remain a stable economic entity.
Okay. You know what? I kind of, as you were talking there, and I said, I've asked an optimist to give me a negative to finish on, but you actually finished on a positive. So, Jim, I really appreciate your time and your expertise. And thanks for coming on.
You're very welcome, Owen, and best of luck with your podcast series.